So our second learning objective is account for the formation of a partnership. So which accounting method standard we are using for partnership? Well, we know that the two popular GAAP in Canada is IFRS, International Financial Reporting Standard, and ASB, Accounting Standard for Private Enterprises. So lots of partnerships are private partnership, so therefore they will follow ASB. Limited partnerships are often public enterprises. So if that partnership is public enterprises, and then they have to follow IFRS, International Financial Reporting Standard. If it's an international partnership, they must follow IFRS, International Financial Reporting Standard. So first step is to form a partnership. So the asset has to be, equity asset has to be contributed by the partners, right? So partner will have initial investment into the partnership, and their investment will be recorded at the fair value of asset contributed. Suppose I am starting a partnership with several other people, okay? And I'm going to invest into the partnership by contributing an office building in downtown Vancouver, right? I wish I owned an office building in downtown Vancouver. Okay, so now the question is, what is the value of my investment, right? So the value of my investment is the fair market value at the time of my contribution. Suppose the partnership start December 31st, 2023. That's the inception date. And I made the contribution, and on that date, my building is worth $10 million, okay? So then, as a partner, my initial investment is a value of 10 million because I made a contribution of the building to the partnership. So that building is not my building anymore. The building is transferred from my name to the partnership. Okay, so I no longer own the building, and the partnership will own the building, and that building's value is $10 million. Okay, this value assigned are agreed to by all partners. Okay, so it's not like I'm saying it's 10 million and it will be 10 million, right? Because I tend to exaggerate my number, right? I'm biased, right? But it has to be agreed by all the partners, right? So probably I would ask some kind of third party give an independent assessment, right? They would do a property assessment and presented a report of their property assessment to all the partners. And they will be convinced that is the fair market value of my building. After partnership formed, okay, transactions is similar to other type of business organization, right? You debit, credit, right? You have different accounts. You analyze all the transaction events, and then you decide which account to debit, which account to credit, right? And then for what amount. So the accounting for transactions is very similar for other business organizations. Does anyone have any question about this part?
No.
Thank you, Anna. So learning objective number 3 is to allocate and record profit or loss to partners, okay? So let's first be very clear about the role of partners. Partners are owners of the partnership. They are not employees, okay? So therefore, partners, they should not receive salary, right? Only the employees, right? They receive salary. They have a salary expenses, okay? So partner are the owners, are the boss. They work for the partnership to earn a profit, not a salary, okay? So normally that profit loss is shared equally among the different partners, but it depending on how the partnership agreement is written, okay? They could have a profit ratio, or we call it profit or and loss ratio. So for example, you have two partners, A and B, right? You and me, we have a partnership. We do accounting work because I'm more knowledgeable than you, right? I have a designation, I have CPA, you don't, you are still learning. Okay, so when we make money, it's probably not a good idea that we share that profit equally, right? Maybe I I will get more, right? I get maybe the ratio would be 3 versus 1, right? I get 3 portion, you get 1 portion, right? So that would be the profit and loss ratio, right? Sometimes depending on the agreement, so that doesn't have to be even distribution. Each partner's share of profit loss is recognized through closing entries. So we're going to see what accounting entries is like, the closing entries is like in the future, in the next couple of slides. You're going to see that. Okay, so profit and loss ratios, okay? So for example, it could be a fixed ratio, 2 versus 1, okay? So I get 2 shares, you get 1 share, okay? All probably based on percentage, right? Maybe, it's 67% for me and 33% for you. A ratio based on capital balance at the beginning or ending of the year, all on average capital balance during the year, right? This ratio could be based on your capital balance, so your contribution, right? If you contribute more, right, you should have a larger portion. So that's the idea. So this ratio can be based on capital balances at the beginning or the end of the year or the average of the year, right? Salaries and the interest allowances to the partners. Okay, so salary and the interest allowances to partners and remainder in a fixed ratio. Okay, so they want to teaser part of the time effort versus their contribution, right? So let's see, you and me, we are two partners, right? So we are making lots of money from the partnership, okay? But I'm too busy with teaching at the university. So you are the person who is doing all the work, okay? But I'm very knowledgeable. I have lots of clients. I can bring people to the partnership. And you are the person who is doing the work. I'm the person who bring all the clients into the partnership. So if we just use that ratio right away, it's a little bit unfair, right? Because you contribute your time and effort, right? I didn't. So if you use like a 3/1 ratio, you probably won't be very happy. So the idea is for you spend the time and the effort, and that part is recognized with a salary. I mean, quote salary. It's not a real salary because you are a partner. You do not make salary. You are not earn salary, but there is this money compensation, right, for your time and effort. So that part is first goal, right? So you have profit. So first, that compensation for your time and effort go to you. And the remainder, whatever left, we're going to apply that fixed ratio, right? 3:1. In that case, you feel being treated fairly because your time and effort are recognized, are compensated, right? And I feel I'm being treated fairly because, right, other than your time and effort, the additional value, right? Because it's my client, I bring them to the partnership. And I'm more knowledgeable. I should get more portion. Right? So you can see there are different ways to allocate profit or loss, right? But the whole point is first, it has to be written in the partnership agreement, has to be agreed by all the partners. Okay, so partners are not employees, right? Partners are the owners, and partners are not creditors. Okay, partners are the owners. So if the partnership accounting, they have to use 4 closing entries for the partnership. So you want to close your revenue account to the income summary. Okay, so how do you do that? How do you close your revenue account to income summary? Can anyone tell me the closing journal entry? How can you close your revenue account into the income summary account? So suppose you have revenue, right? See, under owner's equity, yeah. So suppose you have a revenue of $100 and you have an income summary, right? So we want to close revenue account to income summary. Close means revenue account is a temporary account. So at the end of the year, you have to post the closing entry to reset this account to make it 0. So how can I bring that revenue account to 0? What do I debit? What should I credit? When I close revenue account, what should I debit? What should I credit when I'm closing the revenue account? You debit unearned revenues and credit revenues. Okay, so that is the time that you are earning unearned revenue. Okay, that entry is when you have unearned revenue. People pay you cash in advance, but you haven't earned it, so you record it as unearned revenue. Later on, after you performed your service or delivered the goods, you earned it. You earned the revenue, so you reduce unearned revenue. You recognize revenue. But here, we're asked, this is the last step of the accounting cycle. It's called closing entries. So I'm not sure if you have learned about this in the first course, the closing entries, because these revenue accounts, they are temporary accounts. Okay, so in each fiscal year, on day 0, that balance should be 0, right? Because you reset revenue for each year. You will not consider last year's revenue dollars to belong to this year. So whenever you entered into a new fiscal year, your revenue account, your expenses account, this account all has to be reset to be zero, right? So that's why, we have something called closing entry. We have closed all the revenue account, expenses account at the previous year end, right? Suppose in previous year, your revenue is $100 and you want it to be zero, right? You want it to be zero. So what did you do? Okay. Debit cash? No. So basically, you debit revenue, right? You debit revenue. So only when you have the same balance on the left side and the right side, your T account have a zero balance, right? So now you have to debit your revenue for 100, and then you credit your income summary for 100. And the same idea for expenses. Suppose your expenses is $60, your expenses. And now you want it to be zero, right? Because you need to close this account. This account has to be zero. The only thing you can do to keep it zero is to credit $60. So you're gonna credit expenses for 60. You're gonna debit income summary for 60. Okay, so this one, I'm gonna circle it, has to do something like this. Okay. Now, what is your balance of your income summary, right? Your balance of the income summary is a debit 60, a credit 100. So you have a balance of 40 left. 100 minus 60, you have a balance of 40 left. Okay. So this is the profit. This is the profit. So if it's a profit, so how can you close this 40, right? How can you make income summary to be zero? Right now it's a credit 40. You need a debit income summary for 40. And then you credit each partner's capital account. Suppose this is the equal share, only two partners. So then you will say, I credit partner one for $20. I credit partner two's capital account for $20. Okay. Does this make sense?
Yes.
Good, thank you. Okay, so if you have a partner one, P1, their capital account, CA, capital account. You also have a partner two capital account, right? C2, okay? So now your income summary is 40. You are allocating the 40 to this two, right? To this two account. So you have to debit income summary for 40. So then your income summary will be zero. And then you credit P1 for 20 and P2 for 20. Okay. So it's like income summary. So you have 40, right? Now you're gonna debit 40 to make this to be 0. And you're gonna credit PA, P1 capital account for 20, and you're gonna credit P2 capital account for 20. Okay. If it's a loss, it's gonna be the opposite direction, right? It's gonna be the opposite side. And then the partner will have drawings, right? So the partner has to make a living, right? They need a cash, right? Suppose the partner have nowhere else to make money. They have to withdraw money from the partnership, right? So they have a account called withdrawing, right? Drawing, like P1 drawing, partner one's drawing, and P2 drawing, right? P2 drawing, partner two drawing. So let's say every month, partnership one's drawing is $10 per month. Sorry, $1 per month. So then over a year, this drawing will be $12, right? And now this fourth step is to close each partner's drawing account to their respective capital account. So I want to close this drawing account because it's end of the year. So this should be 0. So therefore, I have to credit my drawing. I have to credit my drawing for $12 to close this drawing account. So when I credit my P1 drawing, I need to debit my P1 capital account. So at the end of the day, you have a credit of 20, you have a debit of 12. At the end of the day, the P1 partner one's capital account has only $8. Okay, does that make sense? Okay, 1, 2, 3, give me a thumb up if you understand everything. 1, 2, 3, give me a thumb up if you understand. Okay, does anyone have any question? Okay, good. I will move on. Okay, so this is the end of this learning objective.